Hello everyone. Manage stock market multibaggers with risk management. Applying the risk management theory which we discussed in one of the videos a week ago for stock market multibaggers. Multibaggers are those stocks which multiply multiple times. This video is only for education purpose and for any investment purpose you may consult your brokers because high returns always have very high risks. One in hand is better than two in the bush, which we all heard since our childhood. It's a common saying. Every youngster hears this from the parents, from the teachers, from everyone. It's very safe to keep one and leave those two which are there in the bush, because bush has a threat of risk. We may get hurt, we may lose what is there in the hand, and we may be left without anything. But a man came with a different philosophy, different thought process, who told this world and taught this world that two in the bush is always better than one, because two is a higher number than one. That was Mr. Warren Buffett, who is one of the richest man, who made a huge fortune managing his risk very effectively, showing this world that the risk can be managed scientifically if you are more cautious and careful. It's a common conventional wisdom that having or investing in blue chip stocks can fetch you around 15 to 20% of returns consistently year on year without any risk or without much risk, where a negligible amount of risk. So that's the safest way to make money in the stock market. If you are averse to risk, then this is the best way for investing in stock market. Blue chip stocks are very safe. Like blue chip stocks means the big ones like MRF, Nestle, huge. As of now, it requires huge funds. Moderately better are say now TCS, Asian Motors, or Infosys, something like those can fetch you confirmed returns of 15 to 20% year on year. That's the best bet. Keep away if you are averse to risk. If you want risk, if you want to take risk and get slightly more benefit, then look to the other side where there is more returns. The higher returns will give you higher risk in return. So, but learn how to manage this risk in this world where there is a theory behind everything. The risk theory is also very mature now almost. Learn to take this risk with these multibaggers. Multibaggers can multiply returns multifold in short time or slightly reasonable good time. These two graphs I have shown a trajectory of this shares, which are normal blue chip stocks, grow slowly, same pace year on year, whatever may be the surroundings, except act of God like corona cases like this 8-9 months, they were all beaten down, but they have come back to normal again. Then whereas risky multibagger stocks are unpredictable, they behave with high volatility and posing high risk, and if you are scared of taking the risk, keep away. Otherwise, go plan for it. If you have a portfolio packet, then divide this portfolio into 70-30, or conservatively to begin with you can have 80-20 also. Subsequently with experience you can increase it, but 80-20 for a beginner is fine enough, but slightly if you are a risk taker, 30-70 is reasonably good. And 70% keep it for those blue chip stocks, fundamentally good stocks, so that your foundation is strong. Whatever, even if you lose this 30% or 20%, these stocks can make it in a year or so. That 70% or 80%. That ones also have to be divided into 3-4 of them or 5 of them as convenient to you, so that distribution is always better. If one fails, the other one will hang on and give you returns. The other 30% is meant for The risky shares, that also you need to identify and divide between preferably 2 to 3 shares. Never one, never in one, because if one fails, everything fails. The failure probability is slightly more than the blue chip stocks. That's why you need to be more careful with these kind of stocks. Then make a this chart like this, what I have shown for risk and opportunities. What are the risks? After identifying these 4 or 5 stocks, chart it against these risk opportunities. For each stock, evaluate the risk and evaluate the opportunities. It could be financial, and identify this risk as per your fundamental analysis data available in any of the apps like Money Control or Investing. Pick up those data given there, plot it, plot the risk here. They also, some of those apps also have this risk matrices plotted against these stocks. Then check for the risk problem, identify the opportunities, evaluate them as much as possible. These should be the stocks which are around 10 rupees or 2 digits, 30 rupees, 40 rupees. Like say we just saw Jet Airways starting from 1,000 odd rupees it was there when it was operational, but when it went bankrupt it fell down to 30-40 rupees, and now it's back again. The news that somebody is purchasing this company, like Ruchise was another live example. From 30-40 rupees it has gone to around 1,000 and come back to 600. And Trident is also doing good. Trident seems to be fundamentally sound, but somehow it is stuck with this range. Maybe after consolidation it may take off after some time. Then Noda Idea is one thing, and S-Bank is another one. Reliance Naval is another one. TTML is a good stock because it's owned by Tatas. So there are so many stocks like this. You need to do some research and plot them, and after analyzing this risk against opportunities, put them into SWOT chart as I have shown you here. Strength, weakness, opportunity, threat. You identify strength, weakness, opportunity, threat as indicated. It could be, threat could be financial threat or customer loss threat or something, policy threat, whatever it is. You can plot it and give it a marking out of 10 and evaluate where it stands. Above 5 or 6, probably it will be a good rating to accept it. Below 5, it may not be a good one to accept it. The threat will be higher or lower, risk is higher. So plot a SWOT analysis like this, what another chart I have shown you for specific examples of what idea and S-Bank. It is a rough calculation for a reference only. You may not consider to use it. It's only for reference, and plot it like this and select or reject according to your risk appetite. Once again, I would like to reiterate here, this is a sample process of applying the risk methodology which we have discussed in the earlier video. How do you apply here? Only for that, for investment purpose, you consult your brokers and so. But however, this can be taken for understanding how the process works. Now, this the inputs for all this can be obtained from this apps like Money Control and investing.com, which I have shown here. They have all the details required for an investor to study and do the research, and at least most of the details are readily available. Then come and plot this risk matrix into 5x5 or 3x3. Last time we have discussed in our earlier video 3x3 matrix. Now here I have plotted 5x5 also for reference, for only for education purpose. How do you plot this and how do you choose this? Now high risk I have identified in red color and low risk is in green color. So I have given 3 into 3 in 9 for significant rating, that is cutoff rating for 1, and 2 into 2, that is 4 cutoff rating for the smaller matrix. So you may choose according to your convenience and your risk appetite which significant rating you want to choose, and then accordingly go ahead with it. This is once again for your reference. This is as comfortable as possible. You can apply and study and use it or leave it. Don't use it. It's education purpose video. Again, I would like to repeat, this is Vodafone sample I am showing you for Vodafone Idea stocks. I have just roughly calculated according to my understanding. There is a risk, however, risk versus benefit also. Risk versus benefit when we have to find out where it stands into these matrices. Then accordingly you can choose the stock, applying both the methodology of SWOT, risk opportunity SWOT, and risk matrix. Then you can select or reject the stocks. Having your blue chip stocks safely at 70-80% of your portfolio, then trying this gamble of risk management initially, and you get better expertise as you practice, keep practicing slowly to understand this application of the risk methodology, risk management methodology. Thank you, gentlemen. And if you like this video, please press bell, like, share and subscribe for me to keep going and bring some new video for you. Thank you, gentlemen.